Welcome to Shortview Trading. My name is Chris Watling. I'm the CEO and Chief Market Strategist of Longview Economics and Shortview Trading. And this is your morning market hit for Monday, 14th of October. And in this video, we want to talk about how should you go about investing in equity index futures on a 1 to 2 week basis. What factors do you want to think about? What should you consider? What should you take into account as you try and decide whether to go long or short equity index futures on that 1 to 2 week swing time frame? And the first thing to think about before you decide whether to go long or short equity index futures is the context of the global price action. How are global financial markets trading? What's the S&P 500 up to? How's it interacting with the bond market and oil and gold market? How are the cross correlations of global financial assets playing out? Because the S&P 500 on Friday closed at another record high, 5,815, up over 21% year to date, up over 6% since the 1st of July in the second half of this year, and really motoring along quite nicely, breaking out of a trading range in the middle of last week, breaking out to the upside. And with that strength, it's moved to an expensive valuation. If you look at the S&P 500 on a forward PE ratio, using consensus rolling 12-month forward earnings, you'll see that it's on over 21 times forward earnings. So it's a very rich PE ratio. As the chart shows, it's only been richer really in two occasions in the last 50 or so years. Firstly, in the TMT bubble, late 1990s through to the early noughties, when we had a giant bubble in tech, media and telecoms, TMT, that took the market to an extremely expensive valuation. Arguably, it's most expensive in 150 years. And then secondly, during the pandemic, when liquidity was everywhere, the central bank was printing a ton of money, the equity market got more expensive, over 23 times forward earnings compared to where it is today. So it's really only 2 times it's been more expensive, and both of those are bubbles. And of course, as you can see from the range on the chart, at times the PE ratio on the S&P 500 in the last 40, 50 years has been below 10. We had that at the end of the GFC, and we also had it at the beginning of the 1982 to 2000 secular bull market. So as the market came out of the 70s into the early 80s, when Volcker made money very tight, in 1982 it had a single-digit PE ratio of as little as 6 times when that secular bull market began. So the range in the PE ratio is wide, and at the moment we're towards the top end of that range. And of course the discussion in markets is this is to do with American exceptionalism. The American economy, the American political setup, the American institutional structure, America as a country is exceptional. This idea that's been going around throughout history and more recently throughout markets, that America is really the only stock market to be in. And of course, if you look at America compared to other European markets or other emerging markets over the last 10 or 15 years, its performance is so much better, markedly better, multiples better. And it's really been the only real game in town in the last 10, 15 years in terms of major global stock markets. So the market's expensive. It's been expensive for a bit, and that's probably to do with this concept of American exceptionalism. Tech's been the main game in town, and most of it's in the States. That's where all the earnings growth has come from. But does this help you trade markets on a 1 to 2 week basis, or even a multi-month basis? And of course the answer is no. If you look at this chart we're putting in front of you now, this is a chart showing you the PE ratio at the start of the year, January of each year, going back over 100 years on the S&P 500 and plotting it against the following 12 months return. So each dot is a PE ratio at the start of the year and the next 12 months return in the S&P 500. Now what you observe from the chart is there's absolutely zero correlation between the PE ratio and the returns over the next 12 months. In other words, the PE ratios have no help whatsoever if you want to trade markets on a 1 to 2 week time frame, or even a multi-month time frame, or even to a certain extent multi-year time frame. Indeed, I would argue you've got to go beyond 5 years to have confidence and to use the PE ratio to help you in your investment decisions. You've got to have a 5-year plus time horizon. So it's no use whatsoever on a 1 to 2 week time frame. The question is, what do you use? And that's where our models come into play, because really markets in the short term are about fear and greed. You want to buy markets when everyone's fearful. You want to sell them when they're greedy. And we have a whole suite of models, both short term, which we think of as 1 to 2 weeks, and medium term, which we think of as 1 to 4 months, all of which are based on this concept of risk appetite. Is the market greedy or is it fearful? Is it technically overextended to the upside or the downside? Are people hedged or are they exposed? Those are the sort of questions you want to ask on that 1 to 2 week and that multi-month time frame. And you want to look at models like our short-term risk appetite scoring system you can see in front of you now, or our short-term technical scoring system, or a short-term put-to-call ratio. All of these are very useful when thinking about a 1 to 2 week time frame trade on an equity index future. And then add to that and blend into that the medium-term models, the 1 to 4 month models. What are they saying? What are the medium-term risk appetite scoring systems saying? How greedy is the market on that multi-month basis? How overextended is it on that multi-month basis? And what's the sort of downside put protection that's in place when you're thinking about the medium term? And then to cap it all, we like to look at our sell-off indicator. This is an indicator we designed in 2006. It hasn't changed since then. It's based on excessive appetite for risk. That's what it measures when the market's got greedy and stayed greedy for a prolonged period of time. And we find that we get a signal from this indicator before the majority of meaningful pullbacks. And by meaningful, I'm talking about 5 to 10% or more in the S&P 500. This is what this indicator is good at. And when it crosses plus 20, it starts to give a signal. And as you can see from the chart, that is what it's doing now. So how do you blend that short and medium term view on the equity market? How do you come up with a 1 to 2 week trading decision, whether to go long or short, when you're putting together those short and medium term models? That's what we talk about each and every day in our daily risk appetite product. And we'd love you to take a trial. Simply click on the link below. We'll send it to you for free for a bunch of trading sessions. And if you like it, carry on subscribing. Or if you're a subscriber, should be in your inbox around 9 AM London time every business trading day. So thank you for listening. That was your morning market hit for Monday, 14th of October. Please do follow us on YouTube. Simply click on the subscribe button, like and share on social media, or follow us on Twitter, LinkedIn, and or Facebook. Thank you for listening. Stay safe. Trade well.